If you pay more than $200 a month for life insurance, there is a meaningful chance that between 50 and 80 cents of every dollar you paid in your first year went directly to the agent who sold you the policy, not to your coverage, not to your cash value, to their commission. Most policyholders have no idea this number exists, and the people selling these products have no financial incentive to change that. Two women, same age at 30, same income, same family. One bought whole life insurance at $420 per month. The other bought a term policy for $55 a month and invested the $365 difference every month without fail. 25 years later, the first woman had $94,000 in cash value. The second had $340,000 in her investment account. Both paid for life insurance the entire time. Only one built wealth doing it. This is not a story about bad luck or unusual circumstances. This is a story about a specific financial product that 8 out of 10 Americans purchase without understanding how it is structured, who profits most from selling it, or what the mathematical alternatives produce when the numbers are actually run. The gap between those two women was not created by income, investment skill, or luck. It was created by a single product decision made with incomplete information at age 30. My name is Marcus, and I spent years studying the financial products that ordinary Americans pay for without fully understanding the internal economics. If you are working toward long-term financial security on an income that should be enough, but somehow never quite stretches, as far as you expect, make sure to subscribe to this channel and hit the like button if this information turns out to be useful to you. Let me explain how this situation came to exist, because understanding the mechanism matters as much as knowing the outcome. When you purchase a whole life insurance policy, you are actually purchasing two things simultaneously. The first is an insurance component, the actual death benefit that pays your family if something happens to you. The second is a savings component called cash value, which is designed to accumulate over time and can theoretically be borrowed against or eventually withdrawn. The agent who sells you this product presents both components as features working in tandem. Insurance and investment together in a single product. Protection and wealth building with one monthly premium. It sounds efficient. It sounds like the kind of thing financially responsible adults do when they have graduated past the basics. Here is what most agents do not explain. The internal structure of a whole life policy means your premium dollars get divided between 4 destinations: the pure insurance component, the agent's commission, the insurance company's administrative expenses and profit margin, and finally, whatever remains enters the cash value account. In the early years of most whole life policies, the agent's commission alone can consume 50 to 80% of the first year's total premium. The insurance company's operating costs and profit take a substantial portion of what remains. Actual cash value accumulation in the first several years is minimal compared to the total premiums paid. The Society of Actuaries has published research showing that in most whole life policies, the internal rate of return on cash value, when calculated as a standalone investment, runs between 1 and 3% annually over the life of the policy. The S&P 500 index has returned an average of approximately 9.5% annually over the past 90 years, and approximately 10.7% annually over the most recent 30-year period. The industry's standard response to this comparison is that whole life insurance provides guaranteed returns and protection from market volatility. This is technically accurate. It is also the financial equivalent of pointing out that a savings account is safer than an index fund and leaving out the part where you explain what that safety costs you in long-term wealth accumulation. Here is the specific mechanism that makes this important. When you combine an insurance need with an investment need inside a single product, you pay a premium for the guarantee, you pay a premium for the packaging, and you pay the commission structure that financially rewards agents significantly more for selling permanent life insurance than for selling term. A whole life policy for a healthy 40-year-old woman might cost $400 to $500 per month for a $250,000 death benefit. A 20-year term policy for the same person, same health rating, same benefit amount, typically costs between $45 and $75 per month. The $350 to $400 monthly difference is available to invest separately if you choose term instead. The commission an agent earns on that whole life policy in year one might be $3,000 to $5,000. The commission on the term policy might be $200 to $400. The incentive structure is not subtle, and it operates consistently across millions of transactions every year. The training programs these agents complete are real. The marketing materials address real features. The products serve real functions for specific customer situations. The issue is not dishonesty. It is an incentive structure in which the product that generates the highest commission for the selling agent is systematically presented as the most beneficial product for the customer, and the comparison that would reveal the alternative's advantages is rarely, if ever, initiated by the party whose income depends on the transaction. When a product generates 50 to 80% of the first year's premium in agent commission, agents will find compelling narratives for recommending it broadly. When a product generates 5 to 10% commission, those same agents will recommend it primarily to people for whom it is genuinely the right fit. This pattern appears across multiple categories of financial products sold through commission channels. The consumer's protection against it is the same protection that works in every market with asymmetric information. Doing the comparison yourself, or paying someone whose financial interest is explicitly aligned with yours rather than with the product being recommended. That comparison has been documented in financial planning literature since at least the 1970s. Fee-only financial advisors have been making this case for generations. Yet, as of 2025, most Americans who own permanent life insurance have never seen a direct numerical comparison between their specific policy and the alternative. Let me show you the specific mathematics that Patricia discovered at her kitchen table, because the numbers do not require financial training to understand. They only require seeing them arranged next to each other honestly. Patricia was a 41-year-old dental hygienist in Akron, Ohio. She had 2 children, 11 and 14 years old, and owed $143,000 on the mortgage she had taken out 9 years earlier. Patricia was paying $420 per month for her whole life policy. Her death benefit was $250,000. She had paid into it for 11 years. When Patricia ran the numbers, she found that a comparable 20-year term policy, same benefit amount, same health rating, would have cost approximately $55 per month at the age she originally purchased. The monthly difference was $365. $365 per month, invested consistently in a low-cost S&P 500 index fund from age 30, at an average annual return of 8%, produces approximately $340,000 over 25 years. Patricia's 11 years of whole life premiums had produced $22,000 in cash value. Those same premiums, redirected into an index fund at 8% annual returns, would have grown to approximately $84,000 over the same period. The gap at 11 years alone, $62,000. And that gap would not stop widening. Let me walk through the full 25-year comparison with Patricia and Jennifer, because the numbers at the end are the ones that actually change behavior when people see them. Both women purchased life insurance at age 30. Patricia bought the whole life policy. Her monthly premium was $420. Her death benefit was $250,000. Jennifer bought the 20-year term policy. Her monthly premium was $55. Her death benefit was $500,000. Notice that detail. Jennifer purchased double the coverage, twice the death benefit, for 37% of what Patricia paid every month. Jennifer invested the $365 monthly difference into a low-cost index fund from day one. At age 35, 5 years in, Jennifer's investment account held approximately $27,000. Patricia's cash value held approximately $8,000. At age 40, 10 years in, Jennifer's investment account held approximately $67,000. Patricia's cash value held approximately $22,000. At age 45, 15 years in, Jennifer's investment account held approximately $127,000. Patricia's cash value held approximately $43,000. At age 55, 25 years in, Jennifer's term policy had expired. Her children were grown. The peak insurance need that justified the coverage had largely passed. Jennifer's investment account held approximately $340,000. Patricia's cash value held approximately $94,000. The gap, at 25 years, $246,000. Jennifer had built a portfolio of $340,000 through the mechanical investment of money that was already leaving her paycheck every month anyway. Patricia had built cash value of $94,000 through the forced savings component of a product she had been told was building her financial future while protecting it. Both women spent 25 years paying for life insurance. Both received the death benefit protection they needed during those years. Only one of them used that period to build meaningful investment wealth. There is one objection that the permanent insurance side of this argument always raises, and it deserves a direct answer. Term insurance expires. When Jennifer's 20-year term policy expired at age 50, she no longer had life insurance coverage. If she needs coverage at 65 and her health has changed, obtaining affordable term insurance may be difficult or impossible. Whole life provides permanent coverage regardless of how long you live or how your health changes. This is a real feature. It is also, for most middle-class families in most circumstances, less important than it sounds in the sales presentation. The financial need for life insurance is highest when you have young children depending on your income, when you carry a mortgage balance that would burden your family, when your spouse's financial security depends heavily on your earning power. By the time most people reach 65, most of those temporary dependencies have concluded. Jennifer's $340,000 investment portfolio serves as its own form of permanent financial protection. If she dies, that money passes to her family. If she lives, it funds her retirement and her legacy. The investment account does double work that a whole life policy would have attempted at significantly higher cost. The specific circumstances where whole life insurance provides genuinely clear financial value are narrower than the marketing materials suggest. High net worth estate planning situations where a permanent death benefit serves specific tax purposes. Business continuation arrangements with certain buy-sell agreements. Particular pension maximization strategies for people with fixed pensions and specific estate situations. These situations are real. They represent a small fraction of the people who were sold whole life policies in their 30s and 40s by agents working on percentage commission. Now let me walk through what Patricia actually did after that Tuesday evening, because the process matters as much as the conclusion. The first phase involved understanding exactly what her policy contained. Patricia called her insurance company and requested a complete policy illustration, showing projected cash value growth at both guaranteed and illustrated interest rates through age 65. This document is something every whole life policyholder is legally entitled to receive. The illustration showed Patricia exactly what she would receive under two scenarios: the guaranteed minimum returns written into the policy contract and the illustrated returns projected under favorable conditions. Patricia then opened a free compound interest calculator and entered the same monthly amount at 8% annual returns over the same time horizon. The comparison did not require advanced interpretation. The numbers simply sat next to each other on her screen. The second phase involved understanding her options before acting. Patricia found a fee-only financial advisor, specifically someone who charged by the hour and accepted no commissions from insurance companies or investment product providers. The advisor confirmed Patricia's analysis, explained a provision called a Section 1035 exchange, which allows for certain tax advantage transfers when changing policies, and walked Patricia through the surrender charge schedule in her specific policy. Patricia had held the policy long enough that the surrender charges had reduced significantly. In her situation, exiting cleanly was realistic. The third phase was the actual transition. Patricia surrendered the whole life policy and received $20,200 after the remaining surrender charge was applied. She deposited $6,000 of that into a Roth IRA for the current tax year and placed the remaining $14,200 into a brokerage account invested in a low-cost total market index fund. She purchased a new 15-year term life insurance policy for $58 per month, providing $250,000 in coverage. For the remaining years, her children would be financially dependent. She set up an automatic monthly transfer of $365 from her checking account to her investment accounts, matching exactly the premium difference. Her monthly cost for life insurance dropped from $420 to $58. Her monthly investment contributions increased by $365. Her total monthly outlay remained exactly the same. The fourth phase is the one Patricia is still in. The $20,000 she received when surrendering the policy has grown substantially since. The monthly contributions have added steadily every month without interruption. Her investment account is now on a trajectory that the whole life policy's cash value projections could never have matched. Patricia did not win the lottery. She did not receive an inheritance. She did not change careers or launch a side business. She spent 2 hours at a kitchen table with her policy documents and a compound interest calculator that is freely available to anyone. The first thing you can do before Thursday is the same thing Patricia did on that Tuesday evening. If you own a whole life, universal life, or variable life insurance policy and you have never run a direct comparison against the term plus invest alternative, the single most important action within the next 48 hours is to request a complete policy illustration from your insurance company. Call the number on your policy documents and ask specifically for an illustration showing projected cash value at guaranteed and illustrated rates through age 65. You are legally entitled to this document. Once you have it, open a free compound interest calculator, enter your current monthly premium minus the cost of an equivalent term policy for your current age and health. Set the time horizon to your expected retirement date and use 8% as the annual return assumption. That calculation takes 5 minutes. The result tells you what you need to know. If you are under 40 and currently own whole life insurance purchased in your 20s or early 30s, you are in the period where the comparison is most dramatically unfavorable to the whole life policy, and you have the longest remaining horizon for the alternative to compound. This is the group for whom running this analysis today is most urgent. Surrender charges are often lower after several years of ownership, and the runway ahead is longest. If you are between 40 and 55 with a whole life policy you have held for a decade or more, the transition may be cleaner than you expect. Surrender charges often reduce substantially after 10 years. The cash value you have accumulated represents real dollars worth handling carefully rather than simply abandoning. A 1-hour consultation with a fee-only financial advisor, one who takes no product commissions, can help you understand whether switching makes sense given your specific policy, health status, and remaining investment horizon. If you are over 55, the calculation shifts. Health changes may affect your ability to obtain affordable term coverage. The remaining compounding runway is shorter. This does not mean the comparison is not worth running. It means the decision deserves more careful, case-specific analysis before acting. Regardless of your current situation, 2 things can happen immediately. Find out what type of life insurance you own. If you are not certain whether your policy is term or permanent, call your insurance company today and ask. The customer service representative can tell you in 60 seconds. If you own permanent life insurance of any kind, request the complete policy illustration this week. Every other step follows from that single document. Picture yourself at 65 years old, sitting across from a financial planner, reviewing the assets you will use to fund the next 30 years of your life. In one version of that meeting, the numbers on the table represent genuine options, a meaningful investment portfolio built over decades of consistent mechanical contribution, projections showing your money lasting well past any reasonable life expectancy, a conversation about how you want to spend your time rather than how much you need to limit your expenses. The life insurance you purchased in your 30s served its purpose and expired cleanly, having cost a fraction of what it otherwise might have. In the other version of that meeting, the assets are smaller than they should have been. Decades of premiums produced less than what a simple redirection of those same dollars would have created. The life insurance policies fulfilled their insurance function, but the insurance need could have been met for a fraction of what was paid, and the difference could have been compounding silently every month for 30 years. Both versions of that meeting are available to the same person, on the same income, with the same family. The difference was made in a single product decision, made with incomplete information, decades before that conversation took place. Jennifer's $340,000 portfolio, built from monthly amounts that were already leaving her paycheck, represents 3 decades of retirement flexibility that Patricia's $94,000 in cash value simply cannot replicate. Jennifer did not earn more. She did not sacrifice anything that was visible in her daily life. She simply ran the comparison before 3 decades of premiums accumulated rather than after. The people who sit down with that document are not different from anyone else watching this. They simply decided that an hour at the kitchen table was worth knowing. Patricia was one of them. On a Tuesday evening in 2018, she opened the folder she had been meaning to review for 3 years. Whether you were sitting in that first meeting or the second one at 65 comes down to,